At some point when you're running a small business, you're going to hear the word GAAP. That's GAAP. Never heard of it? Let's break it down. GAAP stands for Generally Accepted Accounting Principles. It's a standardized set of rules for how financial statements should be prepared, set by the Financial Accounting Standards Board in the US. The purpose is that anyone looking at your books, whether that's an investor, a lender, or an auditor, can understand them and compare them to other companies. Without it, one business could record revenue the moment the contract is signed, while another waits until cash actually hits the bank. Those two pictures look completely different, and these standards help prevent that from happening. Do you actually need to follow these rules right now? It depends, but they're pretty much always a good practice. If your business is early stage, bootstrapped, or you're mainly tracking things for taxes, you can usually get away with solid bookkeeping and basic tax compliance for a little while. But the moment you're going after a venture capital raise, a large institutional loan, or dealing with an audit, GAAP will be expected. Setting your systems up correctly now saves you from rebuilding everything later at some inopportune time. Future you will thank present you for getting ahead of it. GAAP covers a lot of ground, but for most small businesses, the biggest shift is moving from cash basis to accrual accounting. Let's say your business pays upfront for 6 months of insurance. On a cash basis, you'd record that expense when you pay it. Your profit for the month would take a dip, and the next 5 months would be unaffected. Under accrual accounting, which GAAP requires, you record expenses when they are incurred and revenue when it's earned rather than when cash changes hands. In this case, you would record the insurance over 6 months using a prepaid insurance account. That way your books reflect the true impact of the expense as you use it, giving an accurate picture of your business to outside stakeholders. That consistency is what makes your finances comparable over time, and it's what lenders and investors expect to see. Internally, many businesses use both GAAP and non-GAAP financials. Taking the insurance example again, your books would show the expense spread across 6 months, which is the GAAP-compliant way to record it. But your internal decision makers might need to see the cash impact of that lump sum payment. So non-GAAP reporting can be useful internally for decisions, even if your formal financial statements need to follow GAAP. Most accounting software like QuickBooks, Xero, and NetSuite can generate compliant statements, but those reports are only as good as the data you feed them. If your transactions are scattered across multiple accounts and spreadsheets, reconciling everything is a headache and small errors add up fast. Keeping things centralized from the start makes a real difference when investors or auditors come knocking. And you don't need a CFO on day one to get this right. A bookkeeper covers the day-to-day. An accountant steps in when you need GAAP-compliant statements or you're gearing up for something bigger. Even occasional guidance from a professional is a lot cheaper than untangling years of messy records right before a fundraise. The full breakdown, including exactly when all of this applies to your situation and how you get ready for it, is in the article linked below. If a raise or big loan is anywhere in your plans, read before you get there. And if this helped, subscribe for more like this coming soon.